Welcome to Corporate Banking Snippets. Snippets are short descriptions of key concepts in corporate banking. This is one of 100 different snippets in the process of being uploaded to YouTube. This one is a management accounting snippet and illustrates how the cash flow forecast works. Management accounting differs from financial accounting, firstly because it is normally never audited, which would generally be the case for balance sheets and income statements seen in annual audited financial statements, and secondly, because management accounting typically provides current or projected information on which management decisions, such as how much money to borrow, can be based. In the cash flow forecast you're about to see, we have taken a 6-month period during which a company borrows money in order to purchase raw materials, processes and adds value to those raw materials, sells the resulting finished goods, repays the money borrowed, and finally makes a cash surplus. Let's move on to the cash flow forecast, and let's start with the grid into which we are going to plug our numbers. Cash flow forecasts are structured around periods of time. In our case, we have used the second 6 months of the year, so our first data comprises July to December in columns 2 to 7. We will use column 1 for our row headings and column 8 for our 6-month totals. Here is the total column. Let's move on to our row headings. Our first 2 row headings, total sales and total purchases, are for information only and do not form part of our cash flow forecast, because some of the transactions will be on a credit basis and some will be on a cash basis. That is why we have double lines under these 2 rows, and that is why we have colored them green so that they stand out clearly. Do not add these figures into your cash flow. Now, let's move on to cash. Firstly, cash in. In general terms, you will want to see most inward cash flow coming from sales. Receipts for cash and credit sales form our first row. In our model, the next big number will be the loan drawdown. In real life, there may be other sources of cash, such as the sales of fixed assets, but let's keep our model simple. Total cash receipts for each month will therefore be the sum of cash received from sales in each month, plus any loan funds. Moving on to cash being paid out, in this model, most outward cash flow will relate firstly to payments for cash and credit purchases, secondly to operating expenses, that is salaries, rent, utility bills, and other cash payments the company has to make in order to keep operating, and thirdly to the loan repayment. Total cash payments for each month will therefore be the sum of cash paid out for purchases, for operating expenses, and for any loan repayments. Let's put in some numbers for July. Sales receipts are 3 million. There is no loan drawn down this month, so total cash in is 3 million. Payments of 5 million have been made for purchases, 2 million has been spent on operating expenses, there have been no loan repayments, so total cash out is 7 million. We now need to consider if we have a surplus or deficit on this first month. Let's use the last 3 lines of our spreadsheet to help us. In July, total cash receipts are 3 million, total cash payments are 7 million. This gives us a deficit of 4 million for net cash flow, that is A minus B. Our brought forward figure in this model is 0. We are starting off with no cash in the bank, so the figure we carry forward to next month is $4 million negative. We will need an overdraft at the bank to cover that shortfall. Moving on to inward cash flow for August, we expect an increase in cash from our sales activity, and also we expect to draw down our loan for $10 million. As far as cash out is concerned, nothing too special. Payments for purchases are a bit lower, and operating expenses have stayed the same. Net cash flow at US dollars 13 million is high because we have drawn down our loan, but we have not spent it on anything. We need to bring forward and cover the 4 million overdraft from July, so that brings our carry forward figure down to 9 million, 13 minus 4. Note how the capital letters A, B, and C guide you through these calculations. On to September, a very small amount of cash, 2 million, has been received for sales in this month. Cash out, however, shows a big increase. The loan funds have been used to buy raw materials for a big order. Check out the purple arrow. linking the loan drawdown in August to the purchase of raw materials in September. With the large outward cash flow in September, net cash flow, A minus B, has become negative at minus $12 million. We have a credit balance of $9 million to bring forward from August, but that will still leave us with an overdraft of $3 million to agree with the bank for the end of September. Cash in and cash out for October are unremarkable. Net cash flow, A minus B, is just $2 million positive. We need to bring forward negative $3 million from the previous month, so we will end up borrowing from the bank just for $1 million at the end of October. So November is where it all comes together. A combination of the company's ongoing business plus the big order generates $32 million in cash receipts, and they use some of this cash to repay the loan. The second purple arrow links the large amount spent on purchases in September with the large sales figure in November, and the third purple arrow in turn shows how the sales proceeds are used to repay the loan. Net cash flow at 15 million is very strong and easily covers the 1 million overdraft from October, leaving 14 million to carry forward to December. Cash receipts and payments for December show continuing positive trends for the business. Net cash flow is 2 million, which added to the 14 million carry forward from November gives cash surplus of 16 million as at December the 31st. Not bad for 6 months' work. In the total column, we need to add up each of the rows from the previous 6 months. Net cash flow is 16 million for the 6-month period, which is of course the same figure as we calculated for December. The end of December is the same day as the end of the 6-month period, December the 31st. For the 6-month period, we started with 0, as the green arrow indicates, and 16 million minus 0 is of course 16 million. So the total column allows you to cross-check your results. So this business used a bank overdraft of 4 million reducing and a 3-month loan of 10 million to generate cash of 16 million in 6 months. Check out our snippet on cash flow statements to understand how cash flow statements differ from cash flow forecasts.